Welcome to Creamer Media's Resources Watch, a weekly video roundup of the events and people making and shaping the news in the mining industry. This week, world heading for shortage of physical gold, fuel cell thrust continuing, and supply and demand fundamentals remain challenging. Confidence in the world order and the ability of governments to manipulate the value of fiat currency is seen to be diminishing, as is confidence in governments as credible sources of capital.
Confidence in the world order and the ability of governments to manipulate the value of fiat currency, that confidence is diminishing. The extent to which governments are being considered as credible sources of capital, I think that confidence is diminishing. And we do what we've been doing for hundreds of years, is we fall back on the only real currency, the only real way of preserving buying power, preserving capital, that is, we buy gold. And we've been kicking around gold and playing around with gold so recklessly in the global markets with the creation of paper gold, as opposed to holding physical gold in a vault somewhere, that I think we might be heading towards a deficit insofar as physical gold is concerned.
The momentum around fuel cell vehicles as one of the zero-emission technologies of the future is continuing to build, as shown by launches and proposed launches of commercially available fuel cell electric vehicles by major car manufacturers.
The journey towards a zero-emission future is well underway, and the trend towards greater electrification of the drivetrain continues. So a topical question at the moment is, so what does this mean for PGMs? We'll attempt to explain that in this slide. If we turn to the top right-hand side graph, the light-duty vehicle automotive market is expected to grow from around 90 million vehicles in this year to about 120 million vehicles in 2025. It's worth pointing out that these figures are not ours, but come from an industry forecaster, LMC Automotive, an expert in understanding all the various trends that are impacting the sector.
While iron ore prices seem to have stabilized, supply and demand fundamentals remain challenging.
The first half of 2016 has been a challenging time for the industry and for our business. Iron ore prices declined 13% to $52 compared to the corresponding period. This was, however, a reprieve from the relentless downward pressure that we had experienced in the second half of 2015. Operationally, it has been a difficult half as we implemented the revised Sishen mine plan and effected restructuring at both Sishen and Kolomela in order to reduce costs. We've made very substantial changes to this business in order to reposition it to be sustainable in the low price environment, which is expected to persist well into the future.
For mining news as it breaks, stay logged on to miningweekly.com and register for our free daily newsletter.